China's economy by 2030. The beginning of this century marked a turning point for China's economic growth, as the country became an important player in the global economy. China's rapid industrialization and integration into the world market led to a significant increase in its gross domestic product, GDP, and the emergence of a new middle class. One of the most significant developments in China's economy during the early 2000s was its accession to the World Trade Organization, WTO, in 2001. This move opened up new markets for Chinese exports, and China quickly became known as the factory of the world. China's manufacturing sector grew rapidly, and the country became a major producer of consumer goods, electronics, and other products. In the years that followed, China continued to experience rapid economic growth, with its GDP growing at an average annual rate of around 10%. This growth was fueled by a combination of factors, including government policies aimed at promoting investment and export-led growth, a large and growing workforce, and a relatively low cost of living. More recently, the Chinese government has unveiled a number of new development plans aimed at further boosting the country's economic growth and competitiveness. One of the most significant of these plans is the Made in China 2025 initiative, which aims to transform China into a world leader in high-tech industries such as robotics, aerospace, and artificial intelligence. The plan also seeks to increase domestic consumption and reduce China's dependence on exports. In addition to the Made in China 2025 initiative, the Chinese government has also launched a number of other development plans, including the Belt and Road Initiative, which aims to increase connectivity and economic cooperation between China and countries in Asia, Europe, and Africa, and the Healthy China 2030 plan, which aims to improve public health and the quality of medical care in the country. It's clear that the Chinese economy has undergone significant growth and development since the turn of the century. However, the country's recent efforts to expand its military and prepare for potential conflicts with Taiwan and the US have raised concerns regarding the future stability of the Chinese economy. In this video, we will examine how China has been allocating an increasing proportion of its GDP towards military expansion and the potential economic ramifications of such actions. Specifically, we'll analyze the various components that may contribute to the destabilization of the Chinese economy before the year 2030. Now, if you're still watching the video, it must mean you're interested. Why not take a second to like the video, subscribe to the channel, and hit the notification bell so you know when we drop next. Now, on we go. The risks of conflict with Taiwan and the US on China's economy. China has been increasing its military spending over the past several years, a trend that is likely to continue in the near future. This increase in military spending has raised concerns among analysts, who warn that it could have serious economic consequences for China, particularly if it leads to a conflict with Taiwan or the United States. China's military buildup is motivated by a number of factors, including territorial disputes with its neighbors, perceived threats to its security, and a desire to project power on the world stage. The country has long been involved in a tense standoff with Taiwan, which it regards as a renegade province that must be brought back under its control, by force if necessary. China has also clashed with its neighbors in the South China Sea over territorial claims, and it has invested heavily in modernizing its military in order to be better prepared for any potential conflict in the region. The United States is another major factor driving China's military buildup. The two countries have a long-standing rivalry, and the United States has recently taken a more confrontational approach to China, particularly under the Trump administration. The United States has increased its military presence in the Asia-Pacific region and has sought to strengthen ties with Taiwan and other countries in the region. China sees these moves as a threat to its security and has responded by ramping up its military capabilities. While China's military buildup may be motivated by legitimate security concerns, there are also economic consequences to consider. China's economy has been growing rapidly over the past few decades, but it still faces a number of challenges, including an aging population, rising debt levels, and environmental problems. Pouring more and more of the country's GDP into military spending could exacerbate these problems and lead to economic instability. For example, increased military spending means less money is available for other important areas, such as infrastructure, education, and healthcare. These are all areas that are crucial for the long-term health of the economy, and neglecting them could lead to serious problems down the road. Additionally, if China were to engage in a conflict with Taiwan or the United States, the economic consequences could be catastrophic. The costs of war are enormous, and the damage to the economy could take years, if not decades, to recover from. There are also concerns about the impact of China's military buildup on the global economy. China is a major player in the global economy, and any significant economic disruption in the country could have serious consequences for the rest of the world. A conflict with Taiwan or the United States could lead to disruptions in trade and investment, which could have a ripple effect across the global economy. Examining other factors that could destabilize the Chinese economy by 2030. There are several other factors that could contribute to the destabilization of the Chinese economy before 2030. Firstly, China is facing a number of environmental challenges, including air and water pollution, soil degradation, and deforestation. These environmental problems could have serious economic consequences, such as increased healthcare costs, reduced agricultural productivity, and damage to the tourism industry. In addition, China's efforts to address these problems could be expensive and time-consuming, which could divert resources away from other important areas of the economy. Secondly, China's population is aging rapidly, which could lead to a shrinking workforce and increased healthcare costs. According to the United Nations, the proportion of China's population aged 65 and over is expected to increase from 12.3% in 2020 to 22.6% in 2050. This could put significant pressure on the country's pension and healthcare systems, as well as reduce the overall productivity of the economy. Lastly, the ongoing trade war between the United States and China has the potential to destabilize the Chinese economy. The two countries have imposed tariffs on each other's goods, which has led to reduced trade and investment flows. This has had a particularly significant impact on China's export-oriented industries, such as manufacturing and agriculture. If the trade war continues, it could lead to further economic disruption and uncertainty. How China could learn from Russia's approach to dealing with sanctions and tariffs. As tensions continue to rise between China and the US, it's important for China to find ways to protect its economy from the impact of potential sanctions and tariffs. One approach that China could adopt is similar to that taken by Russia under President Putin's leadership. One strategy that China could pursue is import substitution. This involves replacing imported goods with domestically produced alternatives in order to reduce dependence on foreign suppliers. For example, China could invest in developing its own advanced technologies like semiconductors, which are currently primarily imported. By investing in domestic production, China could reduce its reliance on imports and shield its economy from the impact of potential sanctions. Another strategy is to diversify export markets. China could look to deepen economic ties with other countries that are less likely to impose sanctions, such as those in Africa and Latin America. This would allow China to reduce its exposure to potential US sanctions by expanding its export markets to other regions. Finally, China could invest in strategic industries and companies that are less likely to be affected by sanctions. This could include investing in domestic defense companies to maintain military capabilities in the event of a conflict. Additionally, investing in companies focused on the domestic market, like healthcare and consumer goods, could help shield China's economy from the effects of tariffs and sanctions. By adopting these strategies, China could better prepare itself to deal with the impact of potential sanctions and tariffs in the event of a conflict with the US. While these measures may not completely shield China's economy from the effects of a potential conflict, they could help mitigate the impact and ensure that China is better equipped to weather any economic storms. Thanks for watching, and please let us know your thoughts and feedback in the comment section below. If you haven't already, go ahead and like the video, subscribe to the channel, and we'll see you in the next one.